Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boissonou. Today, I am here with Kevin Casey and Mr. Michael Simmons. Welcome, Michael.
Thank you, Audrey. It's nice to be back.
Michael, you are the consummate appraiser, the head of an AMC. There's always something going on with appraisals, yeah?
Well, there is, but can I start with two disclaimers?
I was hoping you were gonna start with a quote from the French Foreign Legion, which
Yeah.
Michael told us that he was going to. I thought he was going to regale us with stories from his time in Marrakesh, but then he told me that he would have to shoot me if he told me, and so here we are. We're going to talk about appraisals. Okay, so we're going to have some disclaimers.
So I have two disclaimers.
Okay.
I don't know why there's
another Michael Simmons connected.
I know. I'm trying to.
Yeah, maybe that's.
There we go. I just got rid of it. All right, go ahead.
Well, didn't quite get rid of it, but anyway. So two disclaimers. Number one, I'm not an appraiser, and I don't play one on TV.
All right.
Although just for the curious, I just completed a 7-hour USPAP course over the weekend for us to continue to be licensed in California. So
if you could remind everyone what USPAP means without putting everyone to sleep, that'd be great. You have 30 seconds. Go.
So it's a uniform standards for appraisal practice. It's the Bible of appraising, right? Okay. It's what governs all of us in the industry. The other disclaimer is I just noticed that you used a photograph of me that was taken, I think, back in 1937. My wife found out that I was still using that photograph and just started laughing and said, how are people ever going to recognize you? You don't look anything like that anymore. What's wrong with you?
You still have your hair.
Well, I don't see a lick of difference, to tell you.
I think you look great. So yeah, so that's all good. You're fine.
But those are my two.
I didn't notice a difference, Michael. So
yeah, thanks. You guys are
cool. Well, Kevin probably didn't look at the flyer and realize that the subject line was misspelled either. So we got all that going for us.
I didn't notice that stuff.
All right, so moving right along. So tell me why the head of an AMC or a co-head of an AMC and the guy who's taking the 7 hours is not an appraiser. How does that work? Or
so
an appraiser at one point, right?
Yeah, that's pardon.
Okay, there is a random person here.
So that's actually my chief appraiser, Jim Jenkins. I guess the one that I sent them logged in so that his photograph is on there.
I sent you the one. Okay, we need to cut all this out because this is just a bunch of nonsense. Anyway, I sent you the one that they can log in and watch instead of being there. So
maybe I sent him the wrong one.
Maybe. All right, let's go.
So all right, so we're gonna just leave them up there.
I don't know how to fix this. So.
Okay. Well, if I get in trouble, I'll. Well, look, this here we have quantum entanglement. Apparently,
we can ask some questions
at the same time.
You could just have come sit on your lap. That would solve everything. Let's go.
Yeah.
Okay.
One's in Phoenix, and God knows where the other one is.
Okay.
So, a couple of things. One, just to kind of put a pin in what the scheduled topic is or was, whether or not one should waive the appraisal contingency in a purchase contract.
Well, actually, before we get to that, we didn't get the answer. How is it that you own an appraisal company, but you're not an appraiser?
Oh, well, I was in lending when HVCC showed up.
And HVCC showed up as HBCC.
HVCC, Home Valuation Code of Conduct. Remember when that happened?
Yeah, I tried
10 years ago. And I was a lender, and when I realized what had happened, it just made me mad. Now, getting mad is generally never a good business model. And I guess it's still an open question in my case. But I decided that the only way to resolve it, in order to not have to see appraisers come in from Tracy or Modesto or Pahrump, Nevada, to appraise properties in San Francisco or Marin, wherever I was working at the time. I called two of the best appraisal firms I knew who had been in the business the longest and who I used all the time. And I sat them down at a big round table and said, look, here's the deal. You're now not going to be competitors. You're going to be partners. And their eyes got big and wide and they didn't know what the hell I was talking about. And one of their office managers kind of leaned forward and her eyes got very narrow. And that turned out to be Kim Parati. And then she's my business partner to this day. Because she got it right away. She got it right away. So we literally took the format that I'd always used when engaging appraisers, finding the best appraisers who did the best job, paying them well, and getting the best service that all of my clients always deserve. And we replicated that all up and down the state of California. And then our clients simply drug us to all the other places that they matriculated loans. And that's literally how Axis came into being. And it's been...
That's fascinating, considering I have seen you in many states at many conferences representing the appraisal side of things for so many years. So fascinating. So
I still keep my NMLS license.
I know you do. Yes.
I haven't hacked a loan in 12, 13, 14 years.
Yep. Yeah.
I still have my real estate license, and I haven't done any real estate sales in, I'm not going to tell you how long. It was before they kept good records. That's how long it's been.
Well, yeah, there you go. Okay, so we were going to talk about a few things today.
Yes.
And one of them was the let's start with condo valuations and what's going on in the condo market, because we've actually covered condos a few times recently, and it's really interesting out there. And the reason this kind of popped into my head first is because we did a session with about 150 realtors a couple weeks ago, and we were going to talk about whether it's wise to release a contingency on a condo project right now with what's going on with the associations and the fact that your condo can go from warrantable to non-warrantable overnight, et cetera, et cetera. And we were told that realtors could be, and I quote, offended if we told them that they maybe shouldn't waive contingencies. So just your read on what you're seeing and your people are seeing in the marketplace right now around appraisals and your thoughts on waiving contingencies.
So a couple of things. I just saw a graph day before yesterday that showed that in Florida, and it may have even been in South Florida, but in Florida, there were, a year ago at this time, there were 8,000 condos on the market. And today, there's 18,000. And they're not selling.
Right.
Which is the bigger issue.
Right.
Yep.
And I'd sent you guys, just for the audience's benefit, all three of us serve on boards with CAMP. And one of the things we've been trying to do, we've all tried to do, is to get the GSEs to talk to us about the changing landscape in approving condo projects. By and large, they're claiming we're just busy. We can't take time to talk to you about stuff like that right now, which is just, as far as I'm concerned, it's a tell. They don't know what to do. They don't have all the information. They're too busy trying to realize that there are condo projects that haven't reserved the proper amount of money, haven't done repairs as they should and were obligated to do. And there are insurance companies who literally recognize that ahead of everybody else, and they're just pulling their insurance coverage left, right, and center. State Farm and Farmers did that for commercial properties, and that included condo projects in California. And it's happened across the country. And what that's done is it's thrown your business really into a quagmire. And that's exactly what you're addressing when you say that, you don't dare waive an appraisal contingency or any kind of contingency, frankly, until that loan has closed. Because right up until the moment that you're ready to fund, the GSEs can pull an approval based on new information. And there's no way to tell. There's simply no way to tell. And the last thing anybody wants is to have an uninsurable or an unsaleable loan in their portfolio. It's just a death knell for the industry.
Yeah, the article you sent us about the guy that purchased that, dream condo he had, I forgot the exact numbers, but I think it was like he bought it for $200 and something thousand, and beautiful view of the ocean from this condo. And then they got reassessed with an assessment of, I forget, it was like $1 million or something like that. It was some outrageous amount. And there's no way he could pay it or any of his other people could pay it. And therefore that, they go into foreclosure and they lose their condos, and they, because they can't come up with the assessment, and they can't sell their place to, come up with the assessment because no one wants to buy a place with such a large assessment. And, it's kind of heartbreaking, these people that lose their homes just because of, special assessment for work that was never, should have been maintained the whole time.
Well, that's right. And it's, it's such a dynamic situation.
It is. It's ever changing.
Yeah. And some of the tyranny involved is you're especially vulnerable in a large project where you have multiple ownerships, because it doesn't take very much to shift the entire burden on the handful of the few that stay.
Right.
And it makes them responsible for fixing everything and bearing all those costs, which in normal senses people can't do. So what it does is it's like throwing chum in the water, and you get, predatory lenders or investment groups that want to come in and buy something dirt cheap, so that everybody takes a haircut just getting out, or people just hand back the keys to the lender. Now the lender is stuck with the responsibility of not only protecting their loan, but having to pay more than their fair share of the repair costs, and not doing that opens them up for liability. So I mean, it's like the never-ending gift, right?
Yeah. I remember during the 2008 crisis where someone had a condo and they couldn't afford their HOA dues. And so the HOA was threatening to foreclose on them. But the problem was the place was worth like less than the current mortgage. And it was like all these things, and then all this money was owed, and it was like, well, why would they foreclose on you? Because if they do, then they're taking ownership of all that liability, and you owe them more than the place is worth. I forget the exact amount, but the guy was so underwater, it was like just ridiculous. It's like they actually are better off if they just work with you.
Well, and here's the other thing that I'm really noticing. First of all, CoreLogic came out today with their March rent surveys, and for single family attached or detached, rents were up 3.4% year over year. For attached, they were down 0.6 year over year. First negative reading in over 14 years, which I thought was really interesting. And so I'm wondering, like, is it starting to be felt that there is a shift in that market, because those are townhouses and condos on that are included in the attached. And when the housing policy is all about affordable housing, high density housing, build this, build that, it's all attached, it's all associations, et cetera, et cetera. I mean, what is the bandwidth for the consumer to handle all this? And the idea that a condo is better than a single family, it's going to be easier. And then there are still so many people out there who don't have a clue what's going on with HOAs and the insurance issues, et cetera, et cetera. So again, this is a talking point for us with our realtors, with us, with our associations, with us, with our borrowers, with the consumers in general. Take this information to the public because they don't know. And as the legislators are really pushing this high density housing and this whole environment around, just stack them all on top of each other and it'll be fine. It's not fine. We're seeing that, and it's starting to break this whole idea. And at what point will they catch on and realize that we've got a bigger problem that is going to be exacerbated in some of these situations? So it is, I mean, it's bigger than just, okay, we've got these associations right now that are in trouble. And also the little guys, that's what I'm really the most concerned about. The people on the lower end of the, okay, if you own a $3 million condo, let's hope that you can afford an increase in whatever happens, right? But if you own a condo on the lower end and you're barely scraping by, you're dead in the water. And that's where we're going to start seeing the delinquencies, I think, because people aren't going to be able to afford their dues. They already, and if you're in a state that doesn't have a limit on how much your insurance, I mean, not your insurance, well, that too, but your taxes go up every year, that's just compounded. So if you've had 30% appreciation in the last few years, and now your HOAs have gone through the roof and your income has not followed suit, we have a little problem that nobody's thinking about or addressing. So yeah, keep an eye on it.
You raise a good point. And this is one of my pet peeves is that, there's a lot of unintended consequences in life.
Exactly.
You guys both do loans in San Francisco. So about below market rent properties and how when the builders get a chance to build condos, they have to earmark a certain percentage. Well, you've got $1 million units in there, and then you've got a handful of units that have to be sold for $250,000.
Right.
And the price can't go up any more than, the cost of living for the next decade when you sell. It has to be to another person. Well, if your HOA dues go from $200 a month to $2,000 a month, and your insurance doubles or triples, and you're one of those lucky people that won the lottery and got to buy one of those below market rent units, you're not protected from any of that. And it's just one of those tragic unintended consequences that just kind of wrecks the program, but it just wrecks people's lives too.
But you know what? Some of us saw that coming, Michael. Some of us have known for years that those BMRs are tough. They're tough.
Yes.
I've been talking people out of buying them for years. Like, no.
Me too, because they don't appreciate the same rate that everyone else's properties.
Okay, that's my first question to them is, why do you want to buy a house? Oh, because I want to enjoy the appreciation, right? Well, there is none on these things. It's limited appreciation.
But more importantly, finding a buyer is tough because there's such a limited number of people who qualify for them. And so then when you heap all this on top of it, and again, I'm not hearing our legislators and our regulators talk about this at all. It's really interesting. And so, and by the way, speaking of our regulators and our legislators, there was NBA is meeting in New York right now, which I thought, I'm always interested what's coming out of there. So we've heard from the CFPB director, and we heard this morning, or there was a synopsis in Rob Chrisman's blogs. If you read it, the Chrisman commentary, you can check this out. But he really went after the regulators, and he said that so instead of helping you, the federal government is tying your hands. He's talking about the owners of the IMBs, the independent mortgage banks. It sometimes feels like it's attacking you directly and injure the Americans you serve. He's addressing this crisis today. He has a solution, which I thought was interesting. So it was, he pointed out that they're really pushing the trigger leads bill, which is really would help consumers. Hasn't happened yet. We've been at it, and NAMB has also for years and years. But they roll out all these regulations, but there's no accounting for the return on investment to the consumer. this is supposed to be helping the consumer, right? But all it does is drive up the cost. And how many consumers does it actually help? And so that is something that, I mean, God bless him. I'm like, I want to talk to him because he is one of the few who actually will say exactly what the deal is. We lost that when we lost Dave Stevens. And boy, if this guy is stepping into it, Bob, I never say his name right.
Brooke Schmidt.
Brooke Schmidt. I always, yeah. Anyway, so
yeah, he's a good guy.
He was talking about the CFPB and their attack on junk fees and how that they're calling them junk fees, but they're mandatory for us to close loans. Things like appraisal fees. Appraisal fees are junk fees, really? And credit reports, although that got addressed separately. He talked.
Yet it's Fannie and Freddie the ones allowing credit report fees to go astronomically high.
It's not, I don't even think they allowed it. It's just no one's been addressing it. But now the CFPB is talking about addressing it. We talked last week with Bill Lohman about the FSOC, the Financial Stability Oversight Council, that's trying to increase the oversight and capital requirements on IMBs, all these different things. And so he's proposing that we have a national housing policy director for all things mortgage, which I love this idea because everyone is going in 15 different directions. You got all these agencies, they're all doing something similar or overlapping each other, or, it's a waste of time and energy. And again, how is this helping the consumer? Are they better off today than they were 5 years ago with all these regulations? Meanwhile, the cost to produce a loan has just skyrocketed, right? So
and the cost to build new homes has skyrocketed.
Well, in a lot of it,
regulations,
not just rates, but regulations. So and he cited that there's precedents because they developed the role of the Director of National Intelligence 20 years ago to address similar issues after 9/11, when there were all these intelligence, what were they called? All the agencies, that's the word I'm searching for. Anyway, and they were all like stepping all over each other. And now that's helped. And so and he really called out a lot of the policies by the current administration, which again, every administration has their issues. So very, very interesting. At least that conversation is starting loudly. And it's really important that we pay attention as originators because it impacts us and more importantly, our clients. Our clients are the ones who are paying for all this in the end.
So I would agree. The one thing I would say is that we have to bear in mind that everybody has their own agenda, and that's the problem.
Yeah.
Everybody has their own agenda. So maybe a czar who sits in as
no one said czar, Michael. Don't make it sound like we are entering Mother Russia to make this happen. Okay, it's a slightly negative call over this.
Next you'll be accusing me of being a Republican, and I don't want to wear that label.
Oh my goodness. Okay, we try to stay agnostic here, so we're not.
I know. Hey, listen, you had asked if we could talk about ROVs for a minute,
yes.
and I actually think that that's a really good topic because there's some changes that are afoot, and they become effective in literally 3 months' time.
Okay, so let's
just backtrack with ROV.
Yeah. That's a good place to start. That's a reconsideration of value.
That's right.
What's interesting is that somehow the industry seems to think that this is a new invention. Well, no. It's been around forever.
Yes.
And some of us have always honored it because it was an opportunity for appraisers to help their customers and their lender partners to better understand a process, right? Which is basically opaque. And frankly, won't be less opaque with the new UAD, but that's a whole nother topic for a whole nother day.
UAD?
Uniform Appraisal Data Set. I'll come back and talk about that at some point. It's make your head swim. I know that appraisers are already those that are paying attention are already angry and ready to light something on fire. But let's talk about ROVs for a minute.
Yep.
Come August 29th of this year, Fannie, Freddie, and FHA are going to initiate and make effective a new reconsideration of value process. The one overarching feature is that it's a lender-driven process in ways that it's never been a lender-driven process before. So, well, it was always supposed to be lender-driven and overseen, but that presupposes that there's an internal appraisal department that can help guide their customer, the borrower. And in most cases, they're not. You guys are fortunate. You work for an independent mortgage banker that has a really robust appraisal division, and they're really excellent. We love working with them. They're knowledgeable, helpful. They act as a screen. They act as a translators to help their own internal people, underwriters, understand, and to help their clients, customers, understand the process. There are independent mortgage bankers out there who do $10 billion plus in volume a year, that if you had 3 days and $1,000, you couldn't find a single employee within that company that it had the tag appraiser attached to it. They just don't have anybody.
Yeah. And by the way, just want to point out that that is an IMB, an independent mortgage bank, is a wholesaler or a retailer or both. So
That's right.
just to be clear that he's talking about the places that a broker would send a loan also are included.
That's correct. That's correct. And mortgage brokers, for sure, don't have the ability, the capacity, or the resources to actually understand or manage these processes, right? Mm-hmm. So they have to rely on their funding source to do this for them. Yep. So at every stage, there's going to be an explanation period that takes place. The borrower is now going to have to sign these ROVs, which is new, never been the case.
Why?
They're going to have to sign them, authorize that they take place.
Did we challenge them?
Pardon?
That we actually challenge the
that your request
to challenge the appraisal.
Yes.
Why?
Why? Because it's a borrower-driven process. It may be a lender-driven process, but it's at they are representing the borrower in this process.
Okay, that's important. Go ahead.
And this is uniform from Fannie, Freddie, and FHA.
All right. Well, at least they're focused on the important stuff. Keep going.
So, the same questions are going to be asked. They're going to try. They're trying to encourage a standardized format, but they're not going to provide a standardized format. Now, I'm not sure where that brilliant concept came up, but you give 3 people an opportunity to create something, and you're going to have 4 different variations. It's just the way the world works, right? So, and maybe that's okay, but they're just painting with a broad brush.
Yeah.
So it should all have the same kind of impact. It should all capture the same basic formulas. They're going to limit the number of comparable sales that you can use to 5, number one. Although I'm on committees with various organizations where I've heard lenders say, we're going to limit it to 3. And my response is, I understand why. That should be sufficient. The agencies now say you can have up to 5. If you tell your borrower that they can only choose 3 or offer 3, then is there some kind of bias that's taking place? Can
Yeah.
they claim that you're biased against them for some reason? Is there some reason that you don't want to do it? And I know why lenders don't want to do it. They don't want to burden the appraisers.
Yeah.
They don't want them to have to spend the extra time and energy. And by the way, they have now formalized it to say a borrower may not pay for the be charged for the ROV. Now,
Okay.
we never charged for it. It's a sunk cost for an AMC because you have all of the technology costs, the handling costs, everything else, and it's, you know, it ends up costing us money, and it costs the appraiser time. But
Yeah.
it's
Well, that's
Don't
it's
worry,
part of
it
the contract.
costs us time too. We're all
That's
getting.
right. That's
Well,
right. That's
actually
right.
one of the things I've always thought about. It's like, because I've had appraisers, you know, do appraisals, and like I literally had one time, and it came in on a million something property, like $1.5 million, and it came in $2,500 under the purchase price.
Oh yeah, I've had that.
What was he thinking?
Yep.
Because he is creating more work for himself. Because of course we're going to challenge it. Because how could you be off by $2,500? That doesn't make any
I
sense.
have a theory about that. It involves he's just being a fill in the blank.
Yeah, I often ask. So the question I ask the borrower is like, did you cancel your appointment, reschedule him a couple times? Because I think he's pissed and
Yeah.
he's trying to get back at you. And this is how he's getting back at you. But then the reality is, and I get back at him with a, reconsideration of value, and then he has to do more work, and it's like it's back and forth. It's kind of a silly thing. So I agree with you that there's work, and it's and I do also agree that I don't know how the brokerage shops. This is one of the great things of working for a mortgage bank is we do have a whole department that will
A mortgage bank who has that resource. They don't all.
Yes, they don't. True. We have that. It's a wonderful resource, and they'll even help me when I'm brokering a loan and not going to the bank. And it's just phenomenal how they can come up with all and they basically speak appraisal language, and then they say, here's why you want to consider this value. And most of the time it works. And when I have an issue where, especially on a purchase where the value comes in low, and I talk to the clients about it, I go, okay, well, we have an issue. The appraisal came in low. This is not the end of the world. We have three options. Option number one, we accept the value and just pay in more money. Or option number two, we can challenge it. Two options come with that is number one, they'll agree with our value and then we're all set. Or two, they may meet in the middle. And then you decide whether you want to put in a little bit extra money, or do we go back to the seller and have them come down a little bit? And, of all those options, the only one where you're coming in money is if you decide to do it up front, and you could, not have to come up with more money. And sometimes you get the place for less. Sometimes the place appraises for more. But 2 out of 3 of those options are the better options. So,
okay, Michael, I've done a lot of these ROVs successfully over many, many years. And I've taught people well, not taught them. I've told them how to do it because they didn't, like LOs had no idea, didn't even think. I literally watched a really high producing LO toss an appraisal into the garbage can. I'm like, what was that? And he goes, oh, the appraisal came in low. And I said, was it a good appraisal? And he said, I don't know. And I said, maybe you could look at it and see. Anyway, he told me 3 months later that he had made an extra 15 grand because he had figured out how to do ROVs and he had saved deals. So with that being said, the comp thing is a big deal. So explain this to me. I didn't understand what you were saying. So the lenders are no longer, you can only go up to 5 comps, period. And so like you get your appraisal, it comes in and you've got the 3 comps, and then maybe you have a listing comp and a pending comp. There's 5. Do those all count? And then if you're disputing it, then you go back and you can only add 3 more comps. Explain.
So first of all, let me define something here.
Okay, please.
Not all sales are comparables. They're just sales.
Right.
Until an appraiser determines that there are factors and features that make them comparable to the subject property, they're not really comps. They're just sales. So what Fannie and Freddie and the FHA are all saying is, look, you you get to choose from the marketplace 5 additional data sources, closed sales, to support whatever it is you believe that the value came in, the value wasn't to your expectations, so you believe it's incorrect for whatever reason. Usually that's what the issue is. Or there are errors or omissions in the report, or there were better sales that you could have used that would have been more similar, that would have supported a higher value. So there's a number of reasons that you might want to do that, but they're limiting it to 5 because I kid you not, we've received ROV requests where there's a list of 20 or 25 sales.
Holy moly.
Now that obligates the appraiser to respond to all of them.
Okay.
Which is absurd. And
Okay.
what happened in the old days, it doesn't happen so much anymore, but when CU came out and it would print the list of all of the comps all the sales that were suggested were used in the analysis, right? That were common to that property in some respect. Well, the underwriter just dumped the whole thing in and said, here, comment on these. We think it should have a higher value. Well, this is all part of the educational process that has to take place. So not only do you get a limit of 5, and I think that if somebody wants to submit 5, they should be allowed to submit 5. I think there's a risk of trying to squeeze it tighter. Now, there may not be 5.
Right.
If they're thinly traded markets, there just might not be. But you can go back in time. You can do a number of things if you don't have enough current data. The other thing is you get one bite of the apple. So you want that ROV to be a complete, comprehensive, thoughtful, in-depth analysis as much as is possible for amateurs, because who's going to be putting it together? You can't really ask the AMC to do it. You can't really ask the appraiser to find me 5 different sales that you didn't use that'll make your value go up. And he's going to go, if I had 5 different sales to make my value go up, I would have used them and the value would have been up. But
okay. Well, so let me give 2 examples of when I didn't have somebody, an appraisal department to help me. So in one situation, I had an appraisal that came in with a $50,000 hit for busy road, $50,000. But my client had baby twin boys. And I thought, that's weird. Would he really buy at a busy road? So I called the realtor and I said, well, first of all, I called him and I said, hey, did you think this road was busy? He's like, no. I'm like, okay. So I called the realtor and I said, hey, they're saying that this is a busy road. What do you think about that? No. Great. All right. Well, find me some more comps. You help me, realtor. And she and I got in the car, drove the comps, and literally went and sat at the property for 30 minutes. One car drove by in that 30 minutes, and it made it very, very easy for me to write this little rebuttal. Guess what? My appraisal came in at full value. I didn't have anybody's help other than the realtor and the client. And then on a refi, I had one that came in and it was way lower. We had done a transaction for her previously, way lower than we ever expected. And so I called her and I said, hey, I have a question and I need your help on this because I don't know your neighborhood like you do. And if you could tell me, I'm going to give you these comps, these addresses, and if you could drive around and look at them and tell me what you think about them. Literally, it's someone's opinion, but it's a better opinion than my opinion. Do you know what happened with that neighbor? I mean, was there a dead body in the garage when they, went to view the property? Like, what was the deal with that? And she goes, so she gets the list, she looks at it, she goes, there was a sale like 2 doors down that went for much higher. And the appraiser had completely missed it. So when we disputed the appraisal, did an ROV, and guess what? My refi appraisal came in $70,000 higher than it had originally. Okay, so there are ways having an appraisal department help, let me tell you something. I freaking love that so much. I cannot even tell you. But it is doable if you are creative and on your own. So it is not.
I've done it. I've done it myself on my own. Yeah.
It's not just, it can be on refis too. So yeah. Anyway, Oh my God. Dirk says, I have some properties I would like for you to drive.
Yeah, Dirk's on fire. Dirk's on fire, isn't he?
Dirk's always
Just
on fire. He says use a plug in to get rid of the dead body smell. That's really nice. Okay, so we have a question from Jenny. We have two questions from Jenny. One of them is she wants my email address, which is Audery@mortgagepros411.com. I can't put it in the chat. We don't know how to have the listeners see that. So there it is, Jenny. But also she said, curious, why do we give the appraiser the contract on a purchase, therefore giving them a target value, but we can't give them anything on a refinance? This is a question we hear over and over from LOs, and I think it's a good one. So tell us, Michael, why is that?
Because it's data.
Hey,
It's
Mike.
just data. Yeah, Jim.
I hear a voice.
This is Jim Jenkins. Mike sent me a login to this webinar that, so I'm logged in as Mike, but
Yeah,
in
Jim's
fact,
Jim's our chief appraiser here
Great.
at Athens.
Hi, Mike.
this sounds like a question for my dad.
Yeah.
He's crusty, but it's a good question. So the purchase contract is a data point, and the difference between an appraisal for a purchase and a refinance is, as an appraiser, you're determining if the contract price in a sale is warranted by the market. A refinance appraisal, you're determining what the value is if it were to be put on the market, what the projected value would be. So that's how I explain it to my dad.
So there's no other way to get that info. I mean, like yeah.
So Audrey, that one of the I think complaints that arises from using contracts, and there are some appraisers that really don't want to look at the contract, but the fact is it's imperative that an appraiser analyze the contract to see that it doesn't include, by the way, this includes my priceless porcelain, collection and all my silver service worth, clearly 10% of what the house is. I mean, there are literally reasons why they have to do that.
I get it.
The other complaint is that it tends to encourage confirmational bias. So you tend to come in where the sale price is.
Right.
But that's not the appraiser's job. The appraiser is supposed to use that contract as being an indication of what somebody might be willing to pay under being informed and being free from any pressure. And sometimes it's somebody's just willing to pay more. So it's important for the appraiser to be because you have to remember who the client is in all of this. Client's not the buyer. The client is the lender. The appraiser is providing an appraisal for the lender to make a decision as to their lending decision based on that collateral value. The borrower has the right and the privilege to pay more money than what the lender's willing to lend based on the terms and the underlying value of the appraiser. But that's a personal decision, and that could be borne by a lot of things. Could be borne by the fact that their mother-in-law lives next door, or maybe that's a good reason not to buy the house. Yeah, it could be either way. But you take my so there are a lot of features.
And tying that back into the ROV topic, an appraiser really is to protect the consumer and the lender. So if a listing, so playing by the old rules, the listing agent was able to submit an ROV. Well, that benefits them by way of commission.
Right.
So that's probably the main,
Nice.
that's the main reason for the change in the rules.
Oh,
The borrower has to initiate the ROV to protect themselves. If they want to overpay for the property, that's fine. They can submit an appeal, but a real, the listing agent can't. That's
okay. So first of all, I've never had a
borrower's
listing agent submit an ROV, but in looking for an answer to why on earth would this be a thing, that actually makes sense to make sure. See, for most of us, we come at this as we just want to protect the borrower, right? We would never do this in a situation where we thought it was bad for the borrower. The regulators and, because of the occasional whatever horrible person, they're thinking that we are all going to be operating in our own best interest, and that's not the case. Okay, so that actually explains that. Okay, so we can only have up to 5 comps. It's preferable to have 3 additional. These are additional comps to support your contention that the appraisal should be a different value. All right, what else?
Yeah, yes. By the way, it doesn't really serve your purpose to include comps that are already in the appraisal, but you would be surprised the number of times we see those. Unbelievable.
No. Okay.
I had one just recently came across. So it was actually from a listener that said, "Hey, Kevin, can you help me with this particular deal?" And so they sent me over the appraisal because he goes, "Oh, the appraisal came in low." And so I look at it, he goes, "Well, what did you use when they did the first project?" He goes, "Well, send me that appraisal." So I look at the recent appraisal and it was like, these comps are all in a neighborhood that's definitely not the level of this neighborhood. And then I looked at the previous appraisal and all those comps were in an area that was completely superior to the area that they were buying this place in. So then I went back to, with my appraisal team, and we looked at it and we realized there was no comps for a 2-unit in the area where the place existed. And that's why the 2 different appraisals had come up with 2 different valuations. And both of us agreed that neither of those appraisals was any good. That's like the one that was using the really superior neighborhood, that really wasn't reflecting actual values. And the one that was reflecting the not so, better area was not reflecting, but there was no other comps to use. So it was a problem.
So
Sounds like a case of a lack of data.
Yeah.
So the most complex appraisals, there just aren't comps for.
Right.
I know. I just closed a DSCR that was a single family with an ADU, and there were no comps within 2 miles or 2 years of the property. And so they took the appraisal, but I couldn't use the rents on the ADU unit because of that for this particular investor. So it's interesting how many moving parts there are in all of this and how it all fits together. Okay, so we have Nelson chimed in with confirmation bias, had one just come in at 1.499. Sales price was 1.499. Why not just come in at 1.5? I mean, an excellent question. And that's what always makes us wonder. And it's why the buyers are always like, why is it exactly the sales price? Why? So, and by the way, I'll take that over it being $1,000 under, which I've also had to Kevin's point. Too. So anyway,
that's just kind of dumb, honestly, from an appraiser's perspective. But with that said, I think there's actually a stat out there that 60% of the appraisals come in at purchase price. And because that, by definition, is what the market is willing to pay for it. So if you have 5 offers on a property and it's 1.499, then that's what it's worth. That's if it can be proven and justified and warranted by, historical sales.
Oh my gosh, I wish I could get his picture back, Michael. Good Lord. It would be nice to see him while he's talking. Thank you for being here, by the way. Okay, so Jenny said,
actually, if he just turns on, I think if he turns on the picture, he would reappear.
Michael, you might be able to make yourself reappear. Please feel free to do that. Okay, so Jenny says, how do you feel about cloning reports? I've had many that the appraiser cloned and forgot to remove information. It sends a deal into a tailspin. Could your busy street issue have been a comment that the appraiser forgot to remove from another report they cloned, which is very possible, I would think.
Very, very possible.
But, it's like when we duplicate a file on our end to do another loan for the borrower, and all of a sudden, there's something in there that you're like, oh God, how in the world how did their gender just change? Which just happened to me too. So anyway, hi there. How are you? Not my
cloning. The most tedious and mundane part of the appraisal is typing a report.
Yep.
So if you clone a report, say from, you're appraising a property from a neighborhood that you've previously appraised, all the information and data is pretty much there.
Yep.
So
That's the same thing in our world when, you know, I take, oh, I'm doing another loan for Michael Simmons. I'll just dupe his old loan and then go through and update it. And, oh, wait a minute, I missed the fact that he changed his job, or I missed the
was
fact
divorced or yeah.
you know, so yeah, it happens in our world also.
So
I literally
none
just
of,
said
none
that,
of that
Kevin.
stuff is none of that stuff is a good idea anymore. All of the GSEs now have the ability to compare reports from the same providers and see, in fact, if they've got the same percentage adjustments on all the different elements, if they're allocating the same percentage of value for all the different components. Look to see if the pictures are all consistent and distinct and not just some other picture of some other property. The technology is sophisticated to the extreme, and it's just going to get more sophisticated. Yeah. So it's just not a good idea.
What
one of the things they figured out is that appraisers used a $5 a square foot cost if they were making adjustments, and then they would use it in a neighborhood of $200,000 homes. They used them in a neighborhood of $400,000 homes. They used them in a neighborhood of $1 million homes. How in God's green earth could the same adjustment fit for that kind of price variance, value variance? And the answer is it can't.
Yeah.
But that's just what happened. So that's when they've always had a rule against doing that. And they finally came down and hammered appraisers over that and said, look, that's just lazy.
Good.
Give us the right answer. Do your analysis. Don't just clone stuff.
It also drives me nuts when I mean, there is such a distinct difference between somebody buying a 2-bedroom place and a 3-bedroom place, or a 1-bathroom to a 2-bathroom. And then they give it like a $10,000 bump or a $5,000 bump. I'm like, that makes no sense. But anyway, that's my opinion. Moving right along. Hang on, let me just finish. I had talked to Michael, mentioned the Fannie Mae scanning the reports for bias and what a big difference. And we talked about this last week, so we don't have to go into the whole thing again. But the GSEs are getting very, very sophisticated with what they're able to see, what they are able to glean from the appraisals. And so, you know, this is not the old days when, you know, maybe you get some appraiser who can slip something by. So, you know, if you just are really nice to them, they're really looking at these appraisals and, you know, making decisions from there. Okay, we're going to run out of time, and I definitely want to get to this, which is, so we've been talking a lot about ADUs, and we're going to do a show on them shortly. And one of the things that I'm really curious about, and I wanted to ask you about while we have you, is valuations for ADUs. And people are all excited because it's legal, and they can add an ADU, and they can have a fourplex with an ADU and still be counted as a 4-unit, and they can, you know, put 2 ADUs in their front yard and all this crazy stuff that maybe they can do but shouldn't do, or should think about. But as far as translating onto an appraisal report and value and rents and all that, can you speak to what you're seeing out there in the marketplace and what's happening with this?
You're ahead of the curve, Audrey. What you're talking about is some of the stuff with middle housing upzoning that's going on in Seattle. It's taking place in LA. It's been in existence back in Minneapolis, only now everything is all in a state of flux because there's so many lawsuits flying back and forth that the whole thing is just a kerfuffle. New Mexico is going to create some laws around the same thing. North Carolina, it's growing like topsy, and nobody really has any clear vision around what they're going to do, nor do they understand the different elements and the impacts on the different elements. And you're right, this is a topic that really requires a full hour to sit and talk about, because the way forward is if you have the ability to take a neighborhood and encumber it with multiple ADUs or an additional 2 or 3 units on a property, all of a sudden you've changed the complexion of that neighborhood. And what impact does it have on the subject property on that lot? What does it have on the neighboring properties? What does it do to the services? What does it do to the traffic patterns? And how do you monetize it, right? And originally the idea was we want to provide housing for some of our service providers, our school teachers, our police officers, our firemen, our postmen and women. We want to have opportunities for them to live where they work and live in nice accommodation. That's great. Who's going to do that? You can't compel somebody to make, to create housing and then compel them to make it at lowest cost.
No.
Who would do that?
Yeah.
You're not subsidizing them. You're not giving them money. You're not, it's just not, none of it's been thought out very well. And the problem is the only way that you're ever going to be able to monetize those as individual units is to then condomize your lot, unless you want to create a tenants in common, which is just the whole very thought of that's just a nightmare, right? So it's just the whole thing is kind of fraught with peril. But here's the bottom line: it's coming, and it's going to be coming like a runaway train.
Well, it's here, but it's going to end up, in my opinion. I mean, I can see it ending up like the condo situation right now, where okay, this seemed like a really good idea, but nobody understands who's creating these regulations, etc. The downstream consequences, and and maybe the homeowner doesn't understand them either. Maybe having a tenant in your yard, or 4 of them, where you have to
Not what you want.
Maybe that's not what you want.
No,
Until you spent $250. Okay, but back to the original question, because we are going to run out of time, is how do you evaluate these things? How do you do a valuation on a property with an ADU when there aren't a lot of comps out there with these types of properties? Not everyone all at once.
Well,
it's the same. It's the same. I mean, you have to find comparables with ADUs and extrapolate that.
And then I'm going to
The
follow
difference in value.
I bet it doesn't always increase the value of the property when you add a
No, by definition, an ADU is the contributory value of an ADU is minimal.
Yeah.
If it's equal to the main house, then
I know a good real estate friend, and he did a lot of rehabs and refixes up, and he's learned that if you add an ADU to a place, you actually devalue the sales price, because you limit the number of buyers that would be willing to buy.
And last year you were really limited in how you could count any kind of rental income from that. Now that's changing. Fannie and Freddie are kind of loosening the constraints, so that there are more loan products that will allow that rent to be used to defray the cost of the loan, count as income, but you still can't use it for second homes. You can't use it for investment properties. It's just, it doesn't work. ADUs were originally designed to be granny units, right?
Yep.
Bring your mom or your dad or your kids or whatever. You shove them over on the ADU so they're not bothering you, right?
Yep.
So the whole social complexion of what we're doing is undergoing a kind of tectonic shift, and it's just something we're going to have to deal with on a.
All right. Well, with that, guys, tomorrow we have existing home sales and the release of the Fed minutes from the last meeting. It will be very interesting to see if they have expounded on their plans for the balance sheet runoff that is supposed to start at the end of the month. And Thursday we have new home sales. We didn't even get into inventory, Michael. And we would just like to say, if you are changing companies, or if your company is no longer, can you please let us know what your new email address is, or sign up again under your old or under your new email
address. Yeah.
And
we're seeing lots of little companies disappearing all of a sudden.
Lots of them. And also subscribe to our YouTube channel. It's Mortgage Pros 411 on YouTube. Our friend Jason Bellevue puts it together for us. Thank you, Jason. And so you can go there, you can listen to past episodes, etc. And next week we will have Dr. Elliot Eisenberg joining us, which
Woohoo!
I'm very excited about. We love him, and it's been a
Yeah,
while. So
we do.
with that, thank you, gentlemen,
Hey,
for all of your
one
information
more
today.
one more thing, Audrey. If there were any questions that came through that we didn't get to answer, send them to me and I'll make sure Jim answers.
Great. Thank you,
Thank you,
Jim.
Jim.
Jim,
All right.
next time let me know you're going to be there and I'll send you your own thing with your name on it. You could be, you don't have to be the Michael too. So
Thank
anyway,
you.
with
As
that,
handsome as he is, I don't like posing as Michael. So.
have a great week, everyone. Thank you so much for
Have a
being
good
here.
one, guys. Take care.
Bye.
Thanks, guys.